At Maverick Ag, our goal is to assist and educate primary producers on all forms of business risk management. My name is Evan Schout, and I'm a CPA and CABE certified insurance broker. I've made my career focused on all aspects of primary producer business, including accounting, finance, and farm income programs. Our primary goal when starting Maverick was to provide farms a place to go to discuss, analyze, and identify options surrounding the risks on each of their own individual operations. We have created the Risk Management series of videos to provide farms an introduction into risk management. 6 short presentations that focus on the programs and internal processes that farms can take to reduce the stress that comes with farming. We hope you enjoy the content, and if you have any further questions, please feel free to reach out to us. Thanks for watching. Episode 2 of the Risk Management series. In this episode, we're going to cover the 4 principles of financial risk management. Principle 1, working capital. Working capital is identified as current assets divided by current liabilities. It's the amount of cash reserves remaining after selling all assets and paying all liabilities that are current in nature, due or sellable in the next 365 days. Under current assets, this often includes cash, accounts receivable, prepaid expenditures, as well as inventory. Under current liabilities, it's often your operating credit, any short-term accounts payable, as well as any retailer financing for crop inputs. As you can see in the top right corner, a working capital ratio of less than 1 identifies that you will be repaying any current liabilities with next year's crop as opposed to the crop that you incurred the expenses for. Anything over 1.5 is seen as a position of strength. However, some might argue that a high working capital ratio is a loss of return on equity, as you're not utilizing your cash to get a profitability return. Working capital dictates the ability to manage your profitability as well, to sell grain at the high, to buy crop inputs at the low, and to manage your expenses when due. It also allows for management of cash based on interest rates, debt repayment terms, and farm life cycle. Second principle is debt service. Under the debt service ratio, this is calculated as EBITDA, which is cash earnings, earnings before income taxes, depreciation, interest, taxes, depreciation, and amortization, divided by debt obligations, which includes principal and interest. It's calculated the amount of cash earnings that are required to cover your debt obligations. As you can see in the top right corner, a debt service ratio under 1.15 will most likely put you offside with any of your financial institution covenants. A debt service ratio greater than 1.5 identifies that you have the ability to take on a significant amount of debt in order for expansion, opportunities, or any other items that may come up. Lastly, this is the primary risk ratio for any operation. A shortage here will restrict operations and the ability to compensate any other ratio declines. If working capital ratio is offside, most times debt service will allow you to fix that ratio. However, if debt service is offside, there's no other ratios that will give you the ability to fix the debt service ratio. Principle 3, gross margin. Gross margin is identified as yield times price, or gross revenue, minus seed, fert, and chemical, aka crop inputs. This determines the amount of accrual profitability remaining to cover any variable or fixed expenditures below that line. As you can see in the top right corner, as a percentage of revenue, a gross margin percentage less than 40% shows an inability to cover off other expenditures. A gross margin percentage of greater than 65% identifies that you've utilized your inputs to create a very large gross revenue. Now, in terms of gross margin, the incorrect mindset here is often that gross margin is seen as the least manageable due to external factors such as weather, markets, and reliance on cost structure from industry, or the cost of inputs. The correct mindset in this area is that gross margin is easily manageable, as the agriculture industry has multiple private and government insurance programs to mitigate the risk in this area. External factors are manageable through risk transfer, even though the actual peril, whether it's drought, hail, frost, is outside the control of the producer, but management of these perils is available. Principle 4, cost of production. As you can see based on the graph, average Western Canadian farms from 2006 into 2017 have seen incredible cost increases in both labor power machinery as well as land building and finance areas. The graph in the top right corner, as a percentage of revenue, anything less than 65% shows an area of strength and your costs are low. Anything greater than 85% identifies that you're using a significant amount of your gross revenue just to cover your cost of production. So, management of risk is controlled directly by operational decision making. What I mean by that is most of the expenditures in these areas are management decisions. You buy a new tractor, you add another individual, which increases labor. These are day-to-day decisions that will have an effect on your expenditures. Secondly, external factors have an effect which then dictates the decision by management to take or avoid the new risk. Thank you for watching.